Yesterday was one of the worst performing days in the stock market in the last couple of months because Trump is pushing for a US control of Greenland and is also threatening punitive tariffs on the EU. As investors, when these types of news come out, it is important to take a broader and clear look at the overall market. Now, in fact, today the market has rebounded very nicely. The Nasdaq was down 2% yesterday, and today's up almost 1%, and the same goes for the S&P 500 and the Dow. And if we take a look at the Fear and Greed Index, it is back to 51, when yesterday it was almost in the fear department. So it seems that things are back to normal, but are they? In my opinion, the biggest issue we have in the market at the moment is the valuation. If we take a look at the Shiller PE ratio, which tracks up the last 10 years of earnings, we are almost at the same level we were in the dot-com bubble. Now, as you can see, we are currently at 39, where in the dot-com bubble, we were at 44. And it is no coincidence that according to history, the more overvalued we have been, the next few years have made horrible returns. The clear example is the 2000 dot-com bubble, the 2008 financial crisis, and recently in 2022. What all of this have in common is that valuations were at an all-time high. Because in investing, the key concept we have to understand is that the more you pay for something, the less your returns are going to be. The less you pay, the more your returns. Now, even though we are in an overvalued market, this doesn't mean you shouldn't buy any stocks, but you have to be very careful. So today, I'm going to show you 3 stocks that I believe are a great buy at the moment and 3 stocks that you should avoid. And let's start with JD.com. Think of JD.com as the Amazon of China. It is a beast of an e-commerce business. The current market cap is $40.9 billion and analysts have them rated as a buy with an upside of 42%. Now, if we take a look at the chart, the stock has been struggling massively, down almost 70% in the past 5 years. But currently, the PE ratio is 9, which looks very cheap, although we'll talk later about the valuation with a discounted cash flow model. But now, let's take a look at the financials. As you can see, their revenue has seen massive growth in the past decade, growing from 181 billion Chinese yuans to 1.3 trillion, and last quarter they grew 16%, which is really impressive. Now their profit has also seen good growth as the company used to be unprofitable and now generating 32 billion in Chinese yuans. Now they have less free cash flow, currently at 9 billion, but I am not worried about this low profit because like Amazon, this company is using all their money for growth. In fact, if we take a look at their margins, like Amazon, they are very bad at the moment. Amazon used to have this amount of margins, around 2 or 3%, but now has around 9% because it has stopped spending all that money. And free cash flow margin currently at negative 0.7%, although they usually do between 2 and 4%. Another positive about JD.com is the number of shares outstanding. As you can see, the company, as it has gotten cheaper, management has decided to buy back shares. Now, this is very positive for investors because you own more of the company and you share the profits with less people, basically by doing nothing. And now, if we take a look at the financial forecast, although the company grew 15% this year, analysts are expecting them to grow between 5 and 6% in the next couple of years. Now, profit took a big hit this year, but it is expected to recover and generate $17.15 per share in 2027. If we take a look at some other important statistics, a thing that I love about this company is the balance sheet. The company has $27 billion in cash and $15 billion in debt, which is very valuable for shareholders. And as we have seen, they are using this cash, number one, to buy back shares, and the other to pay a dividend, which currently has a yield of 3.4%, and it is a safe dividend because the payout ratio, which is what percentage of their net income is used to pay the dividend, is only at 32%. And in order to take a deeper look at the valuation, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $37 per share, middle 67 and high 109. And because the stock is currently trading at around $29 per share, this means that if my low assumptions occur, you would get a 15% annual return on your money, middle positive 28% and high 39.5%. So as you can see, huge returns according to my assumptions, and I believe they are reasonable as they have JD growing revenue between 4 and 8% for the next 7 years, averaging a profit margin and free cash flow margin between 2 and 4%, which is around what they have been doing. I assigned the PM price to free cash flow at the end of the 7 years of 14, 16, and 18. And I didn't even assume any share buybacks. So overall, I think JD.com is a very solid company that is heavily undervalued just because it's a Chinese company. And I believe it's good to have some diversification in your portfolio, especially when US stocks are this expensive. But the fact that the US stock market is overvalued at the moment doesn't mean you shouldn't buy any US stocks. In fact, one of the stocks that I am more bullish for the next years is PayPal, another company that has been struggling massively, down 77% in the past 5 years. It now has a market cap of $51 billion and analysts have them rated as a hold, although with a price target with 39% upside. They are now trading at a forward PE of 9, which in my opinion is extremely cheap. And since this year, they pay a dividend which currently has a yield of 1%. Now, if we take a look at the financials, even though people think PayPal is a dead company, revenue hasn't stopped growing. Yes, the revenue percentage growth is less in the past couple of years, but still, this is growth. And if we take a look at their profit, again, they have seen massive growth from $1.2 billion to currently $4.9, an all-time high in terms of net income. And they have even more free cash flow, currently at $5.5 billion. Now again, like JD.com, this company has been buying back a ton of shares. As you can see, around 5 or 6% per year in the past couple of years, which is amazing for investors. And they also have very good margins, as gross margin is currently at 41%, profit margin at 14%, and free cash flow margin at 16%. And if we take a look at what analysts are expecting for the future, they are still expecting growth. As you can see, between 6 and 7% annual revenue growth for the next 5 years and reaching $43 billion in 2029. Now regarding EPS, from $5.46 per share to $9.23 per share. So still a lot of growth according to analysts. And by the way, guys, if you want a discount on stockanalysis.com, which is where I show all the stock data, you have my code in the description. Moreover, PayPal also has a good balance sheet with $10 billion in cash and $17 billion in debt. And obviously the reason I'm interested in PayPal is because of how cheap it is. As you can see, according to my low assumptions, you would get a 17.5% annual return on your money, middle 23.5%, and high 29.5%, which are insane results. And if you want to look up intrinsic value, I always put 10% returns. Why? Because this is what the market gives you. And as you can see, I have intrinsic value of 80, according to my low assumptions, middle 108, and high 144. And my assumptions, I believe, are actually conservative. Revenue growth between 4 and 7%, profit margin and free cash flow margin between 14 and 18%, and PM price to free cash flow of 14, 16, and 18. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Now, on the other hand, stocks that I think you should avoid are companies like Tesla, because they are heavily overvalued. As you can see, the stock is up 48% in the past 5 years, although in the past year it hasn't really moved. Now, the company has a market cap of $1.4 trillion and they are trading at a PE of 290. Now, if we take a look at the financials, although people believe PayPal is a dead company and Tesla a very fast-growing company, Tesla's revenue has been struggling in the past 3 years, and it has even decreased a bit. Their profit reached an all-time high of $14 billion in 2023, although since then it has been struggling and it is currently at $5 billion. A slight positive is that they have more free cash flow, currently at $6 billion, and their margins are not very good. As you can see, gross margin is 17%, profit margin now at 5%, and free cash flow margin currently at 7%. They have this low amount of margins because they are primarily a car business, although it is true they do have some software. Now, if we take a look at what analysts are expecting, as far as revenue, they are expecting Tesla to go back to that double-digit revenue growth, which is great, and profit is also expected to grow massively, as you can see, from $2.10 this year to $11.57 per share by 2030. So huge growth according to analysts. Now, if we take a look at the balance sheet, Tesla has an amazing balance sheet, as they have $41 billion in cash and $13 billion in debt. So this is definitely something we should take into account. But the issue with Tesla is obviously the valuation. I mean, the PE is 290, the price to free cash flow 204, and the price to sales is 14. Just for reference, car companies usually trade at a price to sales of 1, although Tesla does have some software. And according to my intrinsic value calculator, as you can see, it is just heavily expensive. I mean, the stock wouldn't even be a buy according to my high assumptions, in which I have margins of 15%. Another company that I believe is cheap right now is Adobe, ticker symbol ADB, again at a 5-year low, down 38%, which analysts have them ranked as a buy with 44% upside, trading at a forward PE of 12, with a market cap of $119 billion. Now, if we take a look at their financials, we're going to see that they are amazing, from $5 billion to $23 billion. So Adobe has grown revenue at double digits forever. And if we take a look at their profit, it is also amazing, from $1.1 billion to $7.1 billion. And if we take a look at free cash flow, it is a bit higher, currently at $7.8 billion. And again, we have a company that has been buying back a ton of shares as the company has gotten cheaper and cheaper. They also have amazing margins with gross margin at 89%, profit margin at 30%, and free cash flow margin at 36%. Now, analysts are also expecting tons of growth for Adobe. Again, revenue from $26 billion to $35 billion, and profit from $23.96 per share to $33.60 per share. And if we take a look at the discounted cash flow, again, the intrinsic value is between $307 and $571, and the stock is currently trading at $290 per share. So I think Adobe is another fantastic company to buy at the moment. And overall, as we are in a very overvalued market, it is important you take a closer look at valuations and do not buy companies that are heavily overvalued, because they are the ones that will fall the hardest when the market starts to fall. I hope you found this video valuable. Let me know what you think about these companies in the comments, and I'll see you in the next one.